So we clearly feel that every bull market also goes through multiple rounds of correction. We feel that while history does not repeat, it does rhyme once again. And therefore, what happened between 2002 and 2008, which was one of the most longevitated bull market of India, where the Nifty 50 moved from 1,000 points to 6,000 points in 6-year time frame, 2002 to 2008. It was almost six times return. But this return also came with its own bouts of correction, and there were multiple rounds of correction, almost 7 corrections through the 6-year period, with 2 corrections as deep as 30%, which was in 2006 and it was in 2004. But if you see these deep corrections or these small corrections of 10 to 15% in a bull market, typically has been very short-lived. So if you see these red outlines or headlines is indicating that these falls were very short-lived and very quickly market went back into the green. But every time you go through these falls of 30%, 10%, 15%, it generally tends to be read as bear markets and markets are coming to a crash, and all kind of pessimism starts to build in. But if you feel that the long-term picture is looking very, very positive and robust on the backdrop of very strong numbers, then from that perspective, I think these small corrections or these short round of corrections are to be read as more healthy corrections, because they provide an opportunity for investors to allocate more to equities, for investors who have been on the sidelines to once again make entry into equities. We feel that what has happened between 2002 and 2008 will rhyme again between 2000 and 2025. Next 5 years is going to be very, very exciting for India. I've given you a precursor on how strong the earnings recovery we feel is happening. And therefore, these corrections will happen. But stay put through the volatility. Eventually, your overall returns over a 5-year, 7-year, 10-year period will be satisfactory. This is again a depiction of what I said about stocks are slaves of earnings. Again, go back in 2003 to 2008, this patch, which was the best bull market for India. The EPS growth for Nifty was 25% and the price growth was 37%. So 11% was re-rating, right? So in 2009 to 20, which was the worst 10 years of India, where the EPS growth was 6%, the price growth was only 5%. So eventually you will get as much return as the Indian companies will provide. So focus on the earnings growth, returns will follow. Sometimes they come early, sometimes they will come back-ended, but eventually you will make as much money as the companies you own make, or as the companies your portfolio will own, right? Going forward, again, next 5 years, we feel that, as I told you, 700 EPS going up to almost 1,500 rupees, which would be a growth of 29%. And if history has to rhyme again, then base case basis also you should expect a 29% compounded return over the next 5 years by Nifty. And this is Nifty index, right? If the economy does well, and this is what you experience in the Nifty 50, then it's quite possible that the mid cap and the small cap index, or the mid cap or the small cap companies in a rising economic cycle, will tend to outperform the large cap blue chip companies and therefore give a slightly higher return. So I'm making a very positive and optimist case both for the large caps as well as the mid and small caps. And since this call is about India opportunity portfolio, which is more of a small cap portfolio, therefore it makes even more sense for you to stay put some part of your allocations, your equity allocations, in mid and small caps, and India opportunity being one of the options available to you since you've already invested.